I was reading the newspaper the other day. Yes, I still read the newspaper. And I came across something that made me chuckle. There was this investor, bright fellow, made about 180,000 a year, and he told the reporter he'd pulled all his money out of Chinese stocks because, and I quote, everyone knows China's done. Everyone knows. Those two words, they've cost more Americans their retirement than any market crash ever could. Now here's what really got me thinking. This same fellow, 3 years earlier, had dumped his entire bonus, about 35,000, into Chinese tech stocks when they were at all-time highs, when everyone loved them. See a pattern here? Today, I'm going to share something that might make you uncomfortable. We're going to talk about investing in what everyone hates. And I mean really hates. The stuff that makes your brother-in-law at Thanksgiving dinner shake his head and tell you you've lost your mind. Because here's the thing, most people don't realize the best investments I ever made. Nobody wanted to touch them when I bought them. Let me tell you a story that'll help this make sense. Back in 1974, I was buying stocks hand over fist. The market had dropped about 45% from its high. Inflation was running wild, around 11%. President Nixon had just resigned. The economy was a mess. And people thought I was crazy. I remember this one dinner party, and you've probably been to parties like this, where a doctor friend of mine pulled me aside. Nice guy, smart in his field. He said, "Warren, I've moved everything to cash. You should too. The market's going to zero. The market's going to zero." Imagine that. You know what I did? I borrowed money to buy more stocks. Now here's where it gets really interesting. That same doctor? In 1999, he called me up excited as could be. He'd put half his retirement savings into internet stocks. Companies with no earnings, no profits, just websites. He told me, "Warren, you're missing out. The old rules don't apply anymore." The old rules don't apply anymore. I've heard that one before every bubble in history. He lost 60% of that money over the next 2 years. Here's what most people don't realize. Your brain is wired to do exactly the wrong thing with money. You're designed to run towards safety when everyone else is running there, and chase excitement when the crowd is excited. It's not your fault, it's evolution. For 200,000 years, following the crowd kept you alive. If everyone was running from the tiger, you ran too. But in investing, following the crowd is financial suicide. Let me show you some numbers that'll make this crystal clear. According to a Dalbar study from 2023, the average stock investor earned just 3.6% annually over a 20-year period. You know what the S&P 500 returned during that same time? 9.5% annually. Think about that. The market made 9.5, but the average person made 3.6 it. Where'd that missing 5.9% per year go? It went to fear and greed, buying high, selling low, over and over again. Now let's put some real dollars on this. Say you're 35 years old and you invest $10,000 a year for 30 years. At 9.5% annually, which is just buying an index fund and going fishing, you'd have about $1.77 million at age 65. At 3.6%, which is what the average person actually gets, you'd have about $572,000. Yeah. That's a difference of $1.2 million. Same money invested, same time period. The only difference? The average investor panicked when everyone else panicked, and got greedy when everyone else got greedy. Let me give you a concrete example from recent history. In March 20, when COVID hit and the market dropped 34% in about 5 weeks, Americans pulled $326 billion out of stock funds. $326 billion, that's real money from real people who got scared. The market bottomed on March 23, 2020. From that bottom to the end of 20, the S&P 500 went up about 115. But if you pulled out 100,000 in March in a panic and didn't get back in until things felt safe again, you likely missed out on turning that into about $215,000. But here's the kicker, and this is where human psychology gets fascinating. According to Bank of America, 700 billion flowed into stocks in November 2021, right before the market peaked and subsequently dropped about 25% in 2022. See the pattern? Billions flowing out at the bottom, billions flowing in at the top. Now you might be thinking, Warren, that's all well and good, but what does this mean for me today, right now? Fair question. Let me tell you about some sectors that people are running away from like they're on fire. Energy stocks. Now, I know what you're thinking. Warren, everyone says fossil fuels are dead. Electric vehicles are taking over. Why would I invest in oil companies? Here's what most people don't realize. The major oil companies are trading at price-to-earnings ratios of about 8 to 10. That's incredibly cheap by historical standards. Meanwhile, the S&P 500 average is around 20. What does that mean in English? You're paying half price. And here's the thing about oil that nobody wants to hear. The world still uses about 100 million barrels a day. Electric vehicles are growing, sure, but there's still only about 3% of cars on the road globally. The transition is going to take decades, not years. Meanwhile, these companies are printing cash. Exxon's free cash flow in 2023 was around $55 billion. They're buying back stock, paying dividends. But mention buying oil stocks at a dinner party and watch people look at you like you just said you hate puppies. Chinese stocks. Oh boy, here's where I really lose people. The Chinese market has dropped about 40% from its highs. Major Chinese tech companies are trading at single-digit PE ratios. Alibaba, for instance, was trading at a PE around 10 recently. Amazon? Over 40. Now, are there risks in China? Absolutely. Political risk, regulatory risk, transparency concerns. I'm not telling you to bet the farm. But here's a question worth pondering. If Chinese stocks dropped another 20%, would the risks actually be 20% higher? Or would they be about the same, just with better prices? Risk and price aren't the same thing. That's a lesson that's worth tattooing on your brain. Small cap value stocks. These are the boring companies nobody talks about at parties. The regional banks, the industrial manufacturers, the unglamorous businesses that make parts for other businesses. According to data from Hartford Funds, small cap value stocks have underperformed large cap growth by a huge margin over the last decade. We're talking a difference of about 10% annually in some years. You know what that means? Everyone's piled into the sexy tech stocks, the AI plays, the high growth names, and they've abandoned the boring stuff, which means the boring stuff is cheap, really cheap. Some of these companies are trading below book value. That means you're paying less than the value of their assets. Now here's where we need to talk about the hard part. Because knowing this intellectually and actually doing it, those are two very different things. I've been doing this for over 60 years, and I still feel uncomfortable buying what everyone hates. Your stomach still churns a bit. You still wonder if maybe, just this once, the crowd is right. That feeling, that discomfort, that's actually a good sign. It means you're probably onto something. There's this wonderful quote from Sir John Templeton. He said, "The time of maximum pessimism is the best time to buy, and the time of maximum optimism is the best time to sell." Maximum pessimism. Think about what that means. It means reading the headlines and seeing nothing but doom. It means your friends thinking you're foolish. It means lying awake at night wondering if you've made a terrible mistake. But here's what I've learned. The crowd isn't wrong because they're stupid. The crowd is wrong because they're looking at the same information and reacting emotionally instead of logically. Let me give you an analogy. Imagine you're at an auction bidding on houses. There's a perfectly good house, 3 bedrooms, 2 baths, solid foundation. The owner had some legal troubles, nothing to do with the house itself, but it spooked people. You can buy it for $200,000. Last year, before the news, it would have sold for $350,000. Your logical brain says, great deal. The house is the same house. The problems are temporary. But everyone around you is whispering, don't touch it, too risky, something must be wrong. That whisper? That's the voice that's cost millions of Americans their financial freedom. Here's something else most people don't realize. You don't have to be right immediately. In fact, you probably won't be. When I bought those stocks in 1974, they went down for months afterward. I looked foolish for a while, but I wasn't buying for next week. I was buying for the next decade. The question isn't, will this be worth more next month? The question is, will this be worth substantially more in 5 to 10 years? And am I paying a fair price given the risk? So what do you actually do with this information? Let me give you some concrete steps. Step 1. Start small. If you've never invested in hated sectors before, don't put your whole portfolio there. Take 5 to 10% of your investment money and dip your toe in. Get used to the feeling of being a contrarian. Step 2. Do your homework. Hated doesn't mean bad. Some things are hated for good reasons. They're terrible businesses. You need to understand the difference between a fundamentally sound business that's temporarily out of favor and a permanently impaired business. Look at the financials. Can the company make money? Do they have manageable debt? Are they generating cash? These aren't complicated questions, but you need to ask them. Step 3. Use dollar cost averaging. If you believe Chinese stocks or energy stocks or small cap value stocks are cheap, don't try to time the perfect bottom. Nobody can do that consistently, and I've been trying for 6 decades. Instead, buy a little bit every month. If it goes down, you buy more at lower prices. If it goes up, you've already got your position started. Step 4. Give it time. This is probably the hardest part. You need to be prepared to look foolish for a while, maybe even a few years. I've got a rule. I don't invest in anything I'm not willing to hold for at least 5 years. If you're not comfortable with that timeline, you're speculating, not investing. Step 5. Rebalance regularly. This is where the magic really happens. Once a year, look at your portfolio. Whatever went up a lot, sell a bit. Whatever got hated even more, buy a bit more. This forces you to sell high and buy low automatically. No emotion, just math. You know, I think back to that doctor friend of mine from 1970, the one who told me the market was going to zero, then put half his retirement in .com stocks in 1999. He retired a few years ago. Nice guy, still. But his retirement isn't what it could have been. Not because he didn't make enough money. He was a successful doctor, but because he let the crowd think for him. He zigged when he should have zagged. Over and over again. Here's what I want you to understand. You don't need to be a genius to build wealth. You don't need perfect timing. You don't need some secret algorithm. You need patience. You need discipline. And you need the courage to buy what everyone hates when they hate it most. The mathematics of investing are simple. Buy assets that produce value, pay a fair price, and give them time to compound. That's it. That's the whole game. But the psychology? The psychology is brutally hard. It requires you to ignore the headlines, ignore your friends, ignore that voice in your head that says, play it safe. Because here's the final thing most people don't realize. Playing it safe, doing what everyone else is doing, that's actually the riskiest thing you can do. You're guaranteeing yourself average results at best, and likely much worse when you factor in all that buying high and selling low. The real safety comes from thinking independently, from doing your homework, from having the courage to stand alone. I'm 94 years old now, and I've seen this movie play out dozens of times. The crowd panics, prices drop, the smart money buys. Then everyone forgets their panic, prices soar, and the smart money sells. It never changes. Human nature never changes. So here's my challenge to you. The next time you read a headline that makes you want to sell, or hear about a sector that everyone's dumping, pause. Ask yourself, is this actually riskier, or is it just less popular? Because that difference between risk and unpopularity, that's where fortunes are built. Now get out there, do your homework. Be patient. And for heaven's sake, stop listening to the crowd. Your future self will thank you.